Thank you very much for including our paper in this wonderful conferences. Yeah. So the paper is about the spillover effect of P2P lending on the loan losses of commercial banks. And this is a joint work with Jeffrey N. from the Hong Kong Polytechnic University and Choma Rustic from University of Minnesota. And I'm Janus from the Hong Kong Baptist University. So let me briefly introduce what is the peer-to-peer. Given that this conference is all about peer-to-peer lending, so I guess there's no need to dig into deeper about the detail. So basically, the peer-to-peer lending here we refer to a new method of debt financing that allows people to borrow and lend money via the online platform. So here we define the peer-to-peer lending as the online platform. And in our paper, we focus on the US peer-to-peer market, which is dominated by two platforms, the Lending Club and the Prosper. They almost dominate over 90% of the market share in the US. So according to the statistic of the TransUnion, the fintech here refers to those P2P platform and also some other financing relying on the fintech helps to boost the U.S. personal loan market surge to a record, the historical high record of over $138 billion. So if we look at the total unsecured personal loan originated by the fintech loan versus some other channel, like from the bank loan and the credit union and those traditional finance, we can find that the increasing trend of the fintech in recent years is quite obvious, while the other traditional way of financing is a little bit decreased. So that this observation leads us to kind of think there might be some competition, obviously, and also there might be also suggesting that there's some credit expansion to some lower quality borrowers. Yes, indeed, if you look at the aggregate level of the historical charge-off rate, here I just show you the data from the Lending Club, which is the largest US P2P lending platform. And we compare the charge-off rate with the delinquency rate of the consumer loan for all the US commercial banks. And we find that the charge-off rate is much higher than the delinquency rate of the consumer loan, which suggests that the borrower's quality of the peer-to-peer lending platform is not as good as the commercial bank. Yeah, that might suggest some credit expansion to some lower quality borrower because of those fintech provide the funding availability to more people. So those observations motivate us to look at the spillover effect. That is how the P2P lending platform, the development of the P2P lending can affect the traditional bank. Because right now, because of the P2P platform development, the individual or household, they can borrow money from both lender and that is the P2P lending or the commercial bank. So our research question is very straightforward: whether and how the P2P lending affects loan losses recorded by the commercial bank, and also under what circumstances banks are more likely to be severely affected. So to capture the bank's loan losses, we are using the loan loss provisions. And we think loan loss provision is a good measure for the bank's loan losses, because we think that the loan loss provision is a tiny measure because it is an estimate at each of the period end. The manager basically based on their current information to estimate how much of the loan are subject to the future losses. And at the same time, those provisions will be also recorded in the balance sheet. And in the future, if those losses, accrued losses, be confirmed by the actual default of the borrower, then those loans altogether with those allowance will be charged off. So in our main analysis, we focus on the loan loss provision, but later on, we also provide some additional analysis to focus on the loan charge-offs. So why we focus on the loan loss provision? First of all, it is a tiny measure. Yeah, that's make it easier to match the timeline. But at the same time, the limitation is that the loan loss provision data is aggregate data. So basically, the bank, they only report the aggregate amount of the loan loss provision, but there's no specific data related to the consumer loan or corporate loan. We do not have these aggregated data. But on the other hand, we are also interested in looking at the net effect rather than just focus on the loan losses from the consumer loan, which is the focus of the P2P lending platform. I will discuss later that how those P2P lending, which focus on the consumer loan, may also affect the corporate borrower of the bank. So to start with the hypothesis development, I would like first to show you some statistics about the loan purpose. So here is the statistic from our from the lending club. As claimed by the borrower, actually over 60% of the loan are used for debt consolidation, and another 22% are used for credit card payoff. So that is, one might expect that those borrowers, they will use those P2P lending funding to repay their bank loan, because that is indicated by the loan purpose when they apply for the loan. So the repayment of those consumer loans will lead to elective relation between the P2P lending and the bank's loan losses, because the additional P2P funding sources that obtained from the P2P platform will increase borrowers' ability to repay their bank loan. So from bank's perspective, they can be better because their borrowers now have a better ability to pay off their outstanding loan. But on the other hand, there's another channel can also lead to elective relation. That is the repayment of the corporate loan. So it is also possible that the individual borrower, they can also use the P2P funding for personal consumption rather than just to repay the bank loan. They have some consumer loan obtained from the P2P platform, like they are using to buy a car, used for some healthcare medication. So those banks' corporate borrower, especially those local borrower, they can benefit from the boost of the consumer spending. That is, it may increase local firms' profitability and decrease their default risk. So from the bank's perspective, they may be also better off just because their corporate borrower get benefit from the development of the P2P lending. But on the other hand, there are some arguments we argue that there's some channel lead to the positive relation between the P2P lending and the bank's loan losses. The first is the over-leveraging of the existing borrower. So it's in a very old literature that saying that the easy money is the greatest cost of the overborrowing. Yeah, this is quite intuitive for us to understand how the newly available P2P funding will increase the leverage of the borrower because it is so convenient and it is to some extent much cheaper. So for those banks, if their existing individual or household borrower continue to borrow from the P2P lending, then that will inevitably increase their leverage for those household borrowers. And from the literature, a relatively higher leverage can lead to the over leverage problem and also increase the personal bankruptcy likelihood. So in that case, from the bank's perspective, their borrowers are now higher leverage, so they might subject to higher loan losses. So in addition to the over leverage from the existing borrower, the bank may also suffer from the new borrower, which is the lower credit quality. And that is because the competition from the P2P platform. Some commercial banks may extend credit to new customers, like those individual and household borrowers with lower credit quality. And in both ways, like the increase the leverage of the new customer or the existing borrower, in both ways, the bank operating in the area with higher P2P lending will end up with higher leverage individual. And those will both lead to the positive prediction between the relation of P2P lending and bank's loan loss provision. And lastly, there's the recent paper. They are using a unique data based on the credit card registration. They show that the P2P borrower's credit card balance declined right after the origination of the P2P loan, which suggests that they are using the P2P lending to repay their credit card. Okay, but later on, the credit card balance reverted quickly to the original level. So that suggests that those borrowers are becoming even higher over leveraged because they now have both the bank debt and the P2P loan. So in this case, the P2P lending actually lead to a financial spiral where the borrower have to borrow more and more to repay their bank debt, and their financial condition become worse and worse. So that debt consolidation is not always good for borrowers. That depends on the self discipline. So on balance, we predict that the banks operate in a more developed P2P lending market will report higher loan losses. But as I discussed earlier, there are some possible tension behind this main hypothesis. And because our baseline empirical analysis indicates that those the dominant effect appear to be related to the over-leveraging channel, so our subsequent tests focus on providing more support for this channel. In our second hypothesis, we focus on the common lending effect, and the third hypothesis, we focus on the over-leveraged consumer effect, which directly speak to the over-leveraging channel. And in our final test, the additional test, we also focus on how the over-leveraging channel can affect the charge-off specific to the consumer loan. So our first causation hypothesis, that is the common lending effect, we focus on the extent of the common lending. So because the P2P lending platform and the commercial bank, they share the same market. The market is about the consumer loan or personal loan. So in that case, we are expecting that for the bank, if they have a larger proportion of exposure to this market, the consumer loan market, then they are arguably to be more effective. And in our second causation hypothesis, we directly look at the over leverage of the bank's borrower. But in our case, well, it's hard for us to directly observe the leverage of each customer of the bank. So we look at the aggregate level over leverage of the consumer. And we predict that according to the over leverage channel, the effect should be stronger for banks if they are more likely to have lend money to over leveraged consumer. Then that will support our over leverage channel. So in terms of the sample and data, our P2P lending data is from the Lending Club and Prosper, and those data are publicly available. And the bank level data, we collect the bank's financial data from the core report, which is also publicly available in the US. And our sample include the single state bank, which means that those banks, they operate within a state boundary. And our sample start from 2009 and end in 2017. So to match between the bank's data with the P2P lending data, we aggregate the P2P lending volume at the state quarter level, and then merge with the bank's operating state and reporting quarter. So in that case, we define the lending market at the state level, which is consistent with the prior literature, and also consistent with the regulation, because there are extensive regulation on P2P lending at the state level and also for the commercial bank. So we think that the state level market definition is reasonable. So first of all, let's first show you some statistics about the distribution. The first is about the geographic distribution. We can see that there are a lot of variation from across state. And the California, the Texas, they are with the highest lending volume, while there's some other state in the laws with the minimum lending volume. And those variations are driven by many factors, but one of the most factor is the license, because those lending club and the Prosper, if they want to operate in one of the specific state, they have to obtain the state level license before they can operate the business in that state. So in terms of the time series variation, here that's the quarterly lending volume. That is, by each quarter, how much loan originated by those two lending platforms. So as we can see here, in our sample period, it's a striking increasing trend. And in recent years, actually the lender, that is the funding provider, can be divided into individual provider versus the institutional investor. Actually, in recent years, those lending providers are dominated by institutional investor. And later on, we will also test how the individual versus the institutional investor will have some heterogeneous effect on the spillover. So in terms of the research design, we are using a very straightforward OLS model. The left-hand side is the loan loss provision, which is our proxy for banks' loan losses, and the right-hand side is some determinant of the loan loss provision, and especially we focus on the P2P lending volume, which is defined as the lateral log of 1 plus the P2P lending volume aggregated by the state quarter. And there's a bunch of control variables that obtained from the prior literature. We include the bank fixed effect and also quarter fixed effect, and we cluster the standard error at the firm and year to reclustering. So here are some summary statistics. In our sample, because we are focusing on a large number of US banks, the observation is, or the analysis unit is the bank quarter. So the number of observation is over 200,000. And those statistics are generally consistent with the prior literature. So let me get into the empirical result. So first, to test our main hypothesis, we run the OLS model to say that we find that the peer-to-peer, the coefficient on the peer-to-peer lending is significantly positive, which suggests that the over-leveraging effect will dominate our hypothesis, which support that the banks suffer from the over-leveraged borrower. And in terms of the economic significance, this coefficient stands for around 9% when it moving from the 25 percentile to 75 percentile. And we did a bunch of robust tests, and for example, the alternative P2P measures, the with roots down specific state, those results are still hold. So to deal with the omitted variable issue, because our key variable here is the state level, and there might be some other state level variable are omitted. So here we are using the IV approach, and the IV is based on the timing of when the platform will get the state license. And the IV we define here is the number of quarters since both P2P lending platform obtain the license in a particular state. And the longer they obtain, then those borrowers are more familiar with those online platforms, then they are more likely to borrow money from the online platform. And in our second stage, we found similar result with our business result. So in terms of the first causation hypothesis, we look at the common lending effect. Here we use two proxies to measure the exposure to consumer loan market. The first is the level of consumer loan, and the second is the change of consumer loan from T-1 to T. And we get similar result. We interact the unindexed variable of high based on the state, quarter, median value of those partitioning variable. And we found that interaction effect, the interaction are loaded with significant positive, which suggests that when the bank are more exposure to the consumer loan market, then they are more severely affected. And in our second causation hypothesis, we directly look at the over leverage of those consumer borrower of the bank. The first, we use the state level household debt delinquency rate which is the aggregate level of delinquency. And the second is the bank level non-performing loan. The higher non-performing basically will indicate their borrower are more likely to be over leveraged. We find similar result, that is the interaction trend are loaded to be significant positive, suggests that when the borrower was already over leveraged, then they are more likely to be affected by the P2P lending development. So in an additional test, we'll directly look at the component of the P2P lending volume. Here we divide the lending volume into debt consolidation versus other purpose, and also divide the total P2P lending volume into the retail investor versus the institutional investor, because both investors are funding provider. And as I show you in the earlier graph, that institutional investor actually dominate in recent years. And we found that our effect mainly come from the debt consolidation and the retail investor, which suggests those borrowers were using the P2P funding for debt consolidation are more likely to be in trouble, because probably they are on the verge of the bankruptcy or default. For the retail investor, we interpret this result as the institutional investor might have a higher ability to screen the borrower quality, but the retail investors, they might not have that ability to choose the borrower. So the spillover effect are stronger for the retail investor. And also we look at the accounting question. If the bank with higher capacity to accrue for sufficient non-losses, then they might have more freedom. That is, if they have higher earning before loan loss provision or regulatory capital, then they are more free to accrue for sufficient loan losses. And our results suggest that it is indeed that case. And finally, we look at the effect of P2P lending on the loan charge-off, which is the future realized loan losses rather than the estimated amount. And we specifically we look at the charge-off in the future 1 quarter. Here we show you both columns. The first column is about the consumer loans charge-off, and the second column is the total charge-off arising from all type of loans. And we found similar results. That is, the P2P lending actually lead to more future charge-off. That is more future actual default. So let me conclude our paper quickly. That we, based on a sample of US commercial bank, we find that banks operate in a more developed P2P lending state. They have suffered more loan loss provision or more loan losses. And this evidence supports the over-leveraging channel. And the result we also provide some additional results to support the over-leveraging channel. First is the common lending effect. The positive relation is stronger for banks that have greater exposure to consumer loan market. And the second is the over-leveraged consumer effect, that the positive relation is stronger for banks that have lent more to the over-leveraged consumer. And finally, we also show that the effect of P2P lending on the loan losses is confirmed by the bank's increased future charge-off. So overall, we provide some evidence that there are spillover effect from the peer-to-peer lending to the commercial bank. Okay, that's all my presentation. Okay, thank you.
Thank you very much, Janus. My name is Nikhil Vadgama, Deputy Director of the UCL CBT. If we have any questions, we have 2 minutes or so to take them. Otherwise, I'm very happy to supply one for your fascinating presentation. Thank you very much, Janus. I mean, if I start off with, say, the particular question, I mean, in general, looking at your study regarding spillover effects of commercial banks with respect to P2P lenders in the United States, how do you factor in is there any kind of comparable analysis you also have for other markets? For instance, you know, the peer-to-peer lending market in China is incredibly large, is much more dynamic, I would say, than markets in the United States. Is there any kind of thoughts on the similarity or factors between, you know, the study you found here and typically the same kind that you would observe in China there?
I believe so. I think it's a common feature of the P2P lending. That, I mean, our argument, I think it can apply to more of the country rather than just the US. And our argument is kind of generic. That's the over leveraging of the customer. Yeah, they are more likely to, when they already have the bank there, they can also apply, and actually easily to apply for the peer-to-peer lending from the online platform. And we focus on the US just because that's, I think the data availability, yeah, which is one of the most practical issue in the empirical study. The data for the US market is much detailed and almost perfect. But in China, it's hard to get that kind of data.